Okay, continuation of Chapter 17, Video 2, Ratio Analysis. This is where you're comparing one number in relationship to another number. Understand that there are literally millions of ratios. You can ratio anything. We're going to only study maybe the top 15, 20 ratios that's used extensively, but there are a tremendous amount out there. And Cambly software does this today. But it's still important to understand the basics of what some of these ratios can do. The first one is liquidity and efficiency. And we'll have a variety of ratios here. And I think maybe the most important ones to learn right away are these first two, the current ratio and the acid test ratio. Again, these all are used, and the liquidity and efficiency, again, as it's suggesting, what's the short-term liquidity? Your short-term vendors and suppliers are very interested in this and will be using this to analyze the sell to you on credit, as an example, and how efficient the company is being run here, as an example. So, first thing you need to learn is working capital. This is used extensively. And it represents the current assets financed from long-term capital sources that do not require near-term repayment. Basically what it's saying is current assets minus current liabilities equals working capital. Obviously, you want this number to be great, to be positive. You would hope, otherwise you have a liquidity problem. But do you have enough more current assets than your current liabilities? And the stronger that is, the stronger the liquidity and the ability to meet your current obligations. The current ratio is current assets over current liabilities. So look at the difference here. It's current assets minus current liabilities, and here it's current assets over current liabilities. Now you have this dividing into this. Obviously, you want current assets to be bigger than the current liabilities, so the current ratio, hopefully, will always be greater than 1.0. If it's less than 1.0, it becomes a red flag. Even if it even gets close to 1.0, it's actually a flag for creditors and so forth. But the higher this ratio is, the stronger and more liquid the company is. Acid test is a more severe component of the current ratio. So now you're taking the cash, short-term investments, and current receivables. So basically what you're taking out of the current assets is your inventory. You're taking out the inventory because the inventory hasn't been sold yet. And now you're dividing it into current liabilities. And so it's a more severe current ratio. And that's what the acid test ratio. Again, this is used extensively in industry. Some other liquidity ratios, like accounts receivable turnover. How often are you doing the turnover on accounts receivable against your net sales? You are going to be doing this in a project, but again, this will be open book, so you don't have to memorize it, but you definitely should understand and memorize the current ratio and the acid test ratio. Inventory turnover, again, how fast are you turning, or often you're turning over inventory. It's going to be very different, for instance, a grocery store versus a jewelry store, again, according to industry. But this is compared against the industry standards. And another thing is, a thing you want to bring up very carefully here, whenever you see average inventory, and there will be a lot of averages used in these ratios. And the way to get an average is you add some beginning, some ending, and then divide by 2. It could be the beginning of the year, the end of the year, whether it be in sales or inventory or accounts receivable. So be careful when you see this word average. Again, another more ratios. I'm not going to have you memorize this, but understand there are a variety that industry does use, and they want to know how much of your sales is uncollected. Again, it's measuring at one form of measurement on the accounts receivable. Same with inventory. How fast is your inventory growing or shrinking and so forth. Total asset turnover. Obviously, again, they're using average, so be careful. You have to add some beginning to ending and divide by 2. And that's to smooth it out because sometimes this can be manipulated maybe by like year-end numbers and so forth. Solvency is like liquidity, but only on a longer-term basis. And so this is more of your long-term lenders and investors are looking at these kind of ratios. And the big one here, I think, are two of them, the debt ratio and the equity ratio. These are sort of inverse to each other, used extensively. Debt and equity, again, total liabilities over total equity is an example. Debt to equity, again, total liabilities over total equity. Again, used for long term and so forth. An example would be like a commercial bank will be much more stricter to a company if a company has more than 3 times debt to its equity, a 3-to-1 ratio, and so forth. So it begins to affect lending relationships and so forth. Times interest earned, how much money are you earning enough money to pay the interest on the loans? Obviously, this is of interest to long-term investors, creditors. Profitability, again, this is where investors in the stock markets are following very closely. How much is the company generating on its assets, and how much is it making off each sale, and so forth, and how much is the stockholder equity? What's the return for each individual investor? So profit margin is used extensively, and that's the net income over net sales. For every sale, how much is going to the bottom line is really what this is describing. So this is tracked extensively. Return on total assets, how well is the management utilizing the company's resources is really what it's saying. Return on common stockholders' equity. Again, shareholders, this is what drives the stock market. So they want, and notice how they're calculating this. You're getting net income, but remember they're looking for common stockholders' equity. So you have to take away the preferred dividends. The preferred dividends get paid first before the common shareholders. So you need to subtract that out from the net income and then divide by the average common stockholders' equity. How do you get average common stockholders? Divide maybe the ending of 1 year and then the ending of this year and then divide by 2 as an example to get to know how many shareholders are out there. Market. This is used by, again, stock market investors, and these two ratios are used extensively. In fact, the PE ratio is quoted in most financial publications. That is how important that is. And really, what this ratio is saying is how much is an investor willing to pay for the earnings that company is generating. So let's look at this. Market price per common share. Where do you find market price? You don't find it in the balance sheet. You don't find it in the income statement. In fact, you don't find it in the financial statements. You got to go outside. You've got to go to the stock market, or what investors are paying for it today to get the market price. And then you divide it by earnings per share. So, for instance, if you have like an Apple, you'll divide that. Maybe it's earning $10 per share, and what was they paying for the stock? Maybe it's $120 per share, and then you divide it to get a PE ratio of 12. And there's an old adage in the stock market: buy buy low, sell high. But what price is low or high? That's where what they're really trading is buying a low PE ratio and selling a high PE ratio. It's not as simple as that, because there are reasons why it's low and why it's high. You have to look at that. Typically, a high PE stock typically is viewed by the market as having much stronger growth prospects. And so people are willing to pay for that opportunity more. Again, this ratio drives the stock market. Dividend yield, again, some investors want to know, like a bond interest, how much am I earning? It's one thing how much the company's making, but how much am I getting paid for this stock each year? And so it's sort of comparable to like a yield on a bond. This is the dividend yield for stocks. And so here you have a chart, and these are the ratios we're sort of going to do on our financial analysis. You have the different kind of ratios here under liquidity and efficiency, under the solvency, profitability, and market prospects. These are the four major areas, and we will be using these. And I will test some of the major ones: the current, the asset test, debt equity ratio, profit margin, gross profit margin, right? Basic earnings per share, book value. You need to be able to calculate this. PE ratio, very, very important. So definitely study those 5 or 6. Again, analysis reporting, again, is trying to reduce uncertainty in business and investment decisions. And so there's a rigorous and evaluation process, and that's what this does. So an annual report will have more than just footnotes and financial statements. An annual report will also include an executive summary, where the executives summarize the operations and different aspects of the company, maybe a researcher's analyst overview of the company. There could be some assumptions listing, some key factors, and so forth. There's a lot more that goes into analysis than just the financial statements, is what I'm saying here. I'm not going to go into this too much here. I do want to talk about extraordinary items, because this has been heavily abused by management, because management will sometimes try to get ordinary items and try to claim them as they were extraordinary. And the FASB is cracking down on this area. So you should just maybe review these. Sometimes they'll separate out what was an extraordinary event, like for instance an act of God, like a volcano or major floods or something like that. Like a takeover from a foreign country. For instance, Venezuela has been taking over a lot of foreign companies' operations and so forth. Maybe certain changes of laws. But there's a strike, or maybe like a freeze. Is a freeze really that uncommon if you're an orange grower? No, it sort of happens periodically, so it's not extraordinary. And how you account for these two things is being reflected by the FASB, and they are getting more critical on there, because management would often try to say, don't blame me, blame nature or some external event, and that's why they're doing it. Changes in accounting principles. Again, companies can make changes, maybe for tax purposes, changing their accounting, their depreciation schedules as in a method, or maybe their method of inventory costing methods. There could be a variety of reasons. They do have to notify investors and analysts of these changes, and they usually have to show in the year of that change both the old way and the new way. That's the end of chapter 17, and after this I'll do a short video maybe about the project.